Hi, my name is Don Jessup. I'm the owner of Silicon Valley Associates, and welcome to our weekly show. Today I'm honored to have a friend of mine, Dan Lawson, and welcome, Dan, to the program.
Thanks,
Look forward to having you. And tell us a little bit about where you're at and where you're moving to and all of that and the good stuff that's happening in your life.
Well, I'm happy to do that. You know, I've had an incredible career. I'm entering my 30th year in mortgage finance, and I've owned businesses, a number of them throughout my mortgage career. And I'm not that my career is sunsetting, but it's just evolving. And it's evolving now that my focus is not about building a business and creating that opportunity for myself and my family and those that work with me. I've now aligned with Prospect Mortgage. I'm an originator. I've got a team with me, Tracy Starback and Cynthia. And together our single focus is to create a great and an exciting experience for our clients and the realtor partners we work with.
Yeah, and then, as we talked about before, you're not just a mortgage broker, but you're a mortgage planner. Tell us a little bit about that.
Well, mortgage planning is the result of evaluating someone's risk tolerance goals and time horizons to create the opportunity for them or give them the suggestions of different loan options that best fit those three items: risk tolerance, goals, and time horizons.
Right.
Because everybody is very unique, and their goals and their plans and their concerns. When their head hits the pillow at night, I want to make sure I help them into a loan that had them feel like I'm safe and secure for the time I'm going to be in this house.
Absolutely. Last time we were together, we spoke about the essentials of your credit and collateral and the things that go into a loan. This time, Dan, why don't you tell us a little bit about how we can be successful and what makes a really good transaction?
Well, this is a great point, and I think this is relevant for a lot of people. And of course, I'll preface what I'm about to say that lending is very challenging. And it's much more detailed than it was from 2000 to 2007. So based on that premise, understand that we are required to dot every I and cross every T. So the important element I would like to share with everyone is start early and get approved early. Work with your lender. Make sure you follow up with follow their instructions. Make sure you get the information that they're requesting, all the paperwork. Every page. If page 8 of 8 is left blank, if it says page 8 of 8, it doesn't matter. Our underwriters want to see those documents. So work with the lender you're working with, and don't fight them every step of the way, because they're required to dot every I and cross every T. It's just the way the market is. Lenders are offering a great deal of money, and they're required now by the government to make sure that they are protecting you as a consumer and that they're doing everything just the way the government wants it done. So there's a requirement from us as a lending institution and a lending industry to provide proper loan packages of qualified clients. And the way to prove that and document that is with our consumers, and they need to provide us the information that we request. The other thing that I think is very important is once you've started the loan process, lenders want stability. So don't change your job. If you have any changes coming up, you need to speak to your lender. But don't change your job. Don't issue new credit. Don't go to get new credit cards. If your car breaks down, contact your lender before you go buy a new one, because any of these large ticket items may create a change in while you're looking for a home. Your realtor might make an offer on a home based on early information. If you increase your debt load by another $500, it's going to impact your ability for about a $100,000 mortgage. And you may have to come in with that $100,000 in cash just because you purchased a car. It's better to wait for these purchases until after the transaction is closed. There's a lot more flexibility in consumer credit than there is in mortgage lending credit. So be sure to work with your lender. Again, if you need to make certain purchases, I would say communicate, because communication is key with this. Include your lender, and they'll understand and they'll counsel you about the impact of some of the choices you might be thinking of making. And one other important one is avoid making appliance or furniture purchases and things like this. Again, those types of things are very important to wait till after you get your house. I know it's challenging because you think, I've got my loan docs and title, I think everything is done. Well, I'll tell you, at the very end of the transaction, right before the lender funds, every lender runs your credit again. And they won't fund your loan if there's something new that pops up from some appliance store. They're going to want to know, did you increase your debt? And you could hurt your transaction that late into the transaction. This is just something we both see happening from time to time, and this is why I wanted to take the time today to share this. And then I'd like to close with another important point. you provide all this information, your income, your assets, and so on. We run credit. Well, based on the asset piece, work a plan with your lender. Have a strategy of where the money's coming from. If you need to do a consolidation and get all that money in one place, do that early. You need to document it and try to avoid moving money about, because large deposits that move from one account to another will, if you avoid that, you're going to think, gosh, this transaction went very, very smooth. And that's really the point of this. And if you don't, you create hardship for us in trying to create an approval and a clear path for you to get your loan. And it's just going to cycle down to you saying, well, we need to document where this money came from this account to that account. And you're just going to start asking yourself, why is this so challenging? And before you enter the transaction, a good loan originator or a good mortgage planner will walk you through all the steps. In fact, we have the 10 do's and don'ts that we supply to our clients so they understand what things to be watchful for. So I think I've pretty much hit that one on.
Yeah, Dan, it's really important to be able to be complete and to be complete early and don't change anything. Because the minute you change something, even if you're putting cash into your account, a family member gives you $500 in cash, or you didn't use everything and you deposit that, being able to verify where that money came from would be important.
And if someone is nice enough, maybe your Uncle Joe or Granny says, "Oh, I've had this money in a jar, and here's $1,000 for you." And before you deposit that money, you should call the mortgage planner and ask, "My grandma just gave me $1,000. What should I do with this?" Because we have to track every deposit that gets put into your bank account.
Absolutely.
And if you do something like that, it could disqualify the entire bank account.
That's right.
Is that fair? This isn't a question of fairness or not. This is a question of what the lenders want and what we need to provide.
Absolutely. Dan, thank you for coming on to the program. It's always a pleasure. And again, thank you for coming to our weekly show. We'll look forward to seeing you next week.